Hello and welcome. My name is Partha Mohanram and I'm a professor of accounting and the John H. Watson Chair in Value Investing here at the Rotman School of Management. I'm an expert in the area of financial statement analysis and valuation with a specific expertise in the valuation of growth firms and the measurement of the cost of capital. I'm here to answer your questions about financial reporting. Welcome to my office hours. Is it me or does EBITDA sound like a clubbing destination for financial bros? Yeah, if the Beach Boys knew about EBITDA, maybe they would have rewritten the lyrics for that song and said, Aruba, EBITDA. No, but seriously, EBITDA stands for earnings before interest, depreciation, taxes, and amortization. That sounds like a lot, but basically it's a measure of cash flows that a firm generates before taking into account certain expenses. So it's a pre-tax, pre-depreciation measure of financial performance. I personally am not a big fan of EBITDA, even though it's used a lot. The danger of using EBITDA is very often you ignore things like depreciation, which can be a real expense. Companies buy assets and these assets do sort of reduce in value over time. And you also ignore things like taxes. And so I'm not a big fan of EBITDA personally. Insider trading, what information is there that you can give me? Well, not much, sadly, because insider trading is illegal. You're not allowed to trade on material proprietary information you've got from somebody who, for example, works in a senior level in any organization or firm. What you can do is you can trade on private information that you acquire otherwise. So one of the sort of new frontiers on that is looking at information on social media. So what are people tweeting about? What's the sentiment about a firm in the Twitter sphere? And I actually have some research which looks into that as well. In one of my papers, we actually obtained like millions of tweets. These are investors, ordinary investors tweeting about companies. And we kind of analyzed those tweets to figure out what the aggregate sentiment was for a given stock, on Twitter. And what we found was that aggregate sentiment actually predicts how well the firm is going to do in the following quarter, how well the firm's earnings are going to be, and how strong the firm's stock market returns are going to be. Individual investors might not know much individually, but when you sort of look at all these people and you aggregate all the information together, that can actually be extremely useful. Why do CEOs make millions in bonuses when their financial reports show they've lost hundreds of millions in profit? Now, this is a very, very interesting question, and there is no single answer for that. Some of it could be they've actually earned it in the sense that the company was doing even worse and the CEO has come and he or she is in the process of turning the company around. And so they do get a bonus even though the company is making a loss, because the loss could have been even bigger if they hadn't been there. But more often than not, this is simply because in many cases, the executive compensation game is rigged. The people deciding the CEO's compensation is like the compensation committee in the board, and the board very often consists of people who are social associates or close friends of the CEO. These people have gone to the same universities, they're in the same social clubs, they play golf together, etc. And what this means is that their CEO compensation does not have any performance sensitivity. When the company does well, the CEO gets paid incredibly well. When the company does poorly, the CEO gets paid well. How can a company see record profits but still miss expectations? Dude, your company set a record. How is that a miss? Well, let me illustrate this with an example. Let's say you're the shareholder of Apple, right? And Apple had earnings per share of $4 last quarter, and that was a record. The consensus is that the company is going to release earnings of $4.50 this quarter. And Apple comes out and with earnings of $4.40. You see the stock price actually falls. And you ask yourself, how is that possible? 440 is better than 4. Why is the stock price falling? The answer is because the market was expecting earnings of $4.50. And the stock price, which was there before, assumed that the earnings are going to be at least $4.50. So $4.40, even though it's great, is a disappointment for the market. EPS, dividends, GAAP, P&L. God, why do I need a separate dictionary just to read a financial statement? Answer is you don't. And some of these things just become automatic once you get to know them. It's just that people are needlessly spooked by jargon. These things are really, really simple. EPS is just earnings per share. Dividends is what the company pays you. GAAP is just this broad word for the set of accounting rules by which financial statements are created. P&L is just another word for the income statement. It's how well your firm did this year. So these things aren't complicated. It's just that when you don't know something which is very basic can also seem very intimidating. I'm new to investing. What is the most important figure I need to care about in a financial report? Well, this is a difficult question to answer because I wouldn't say it's one figure. There are a bunch of things you need to look at in a financial report. But I'll give you an example of two things people use, one which I don't like and one which I like. So very often people focus on this thing called earnings per share or EPS. I personally prefer a measure called return on equity, which is a ratio of your earnings to the amount of money your shareholders have given you or shareholders' equity. The thing about EPS is earnings per share doesn't really take into account what the shareholders have invested in your company. Firms can devise all kinds of ways to make your earnings per share, bigger. So, for example, companies can just repurchase shares to reduce the number of shares and increase earnings per share. And they really haven't done anything from a performance perspective. But a measure like ROE, return on equity, takes into account how well your performance has been, but also how much resources you've used in getting that performance. Seriously though, why don't financial reports have a too long didn't read section? Unfortunately, we are living in a world where everybody wants things to be in bite-sized chunks. Shakespeare cannot be condensed. I'm not saying financial reports are Shakespeare, but like Shakespeare cannot be condensed into a tweet, right? Very often the richness of financial statements and the value in financial statements is in those details. Imagine you're an automotive engineer and someone says, you've got to get me the specs of this car in like 3 pages. Would you drive a car like that? The answer is you probably wouldn't. When things are important and technical, paying attention to details is extremely important. So financial reports are long, they are complicated, but you know what? That's the way they should be because they convey a lot of very, very important and crucial information. Considering its massive impact on everything else, how will AI transform the financial reporting space? This is an extremely important question. We are seeing big declines in enrollments in accounting programs at the undergraduate level because many people are afraid that the work of an accountant, the CPA, is going to be replaced by AI. You could see a world in which AI takes over a lot of the routine auditing work done by auditors right now. You could see a world where the AI could write the management's discussion and analysis section of a financial report, which traditionally the CEO, CFO, and the investor relations team actually takes control of. You could have a world in which much of the financial analysis, which is currently done by financial analysts, could be done by AI. Now, all of this is going to be very, very disruptive. It could be disruptive simply because the number of jobs in these spaces could be far less in a future world than they are right now. But it could also be disruptive because you need to think about the ethics of AI and you need to have checks and balances to ensure that AI is used as a tool and doesn't become the master in all of these settings. Can companies delay their financial reports when they know the findings are going to spook the stock market? Companies have to release their financial reports a certain number of days after the end of the fiscal year or the fiscal quarter. Now, this is something which is a regulatory requirement. If you're unable to meet that deadline, you can ask for an extension. You can do it, but the consequences are pretty disastrous because why are you doing it? You're doing it because something shady is going on. So you can do that, but then your stock price will crash. You might as well get the bad news out. When it comes to financial messaging, it feels like so much emphasis is placed on record profits and record share prices. Isn't there value in consistent and measured growth, even if it's not record setting? This is an excellent question. And in fact, this is the philosophy of many investors. So if you look at this whole philosophy of value investing, it just says that you should look for consistency of performance and not look for a sort of flash in the pan. So one of my early papers I wrote, and I published this paper way back in 2005, I created this index called G-Score. I was looking at growth firms, the kinds of firms for which there's a lot of hype and so on and so forth. And what I showed in that paper was even in this setting, the ones who do well in the long run are the ones who have consistent performance. The stock market is not a 100-meter sprint. It's a marathon. You don't want somebody who does extremely well and then burns out. You need somebody who's there for the long haul. That's all the questions we have today. If you want to learn more about investing, accounting, and financial reporting, Click the link below to the Rotman Insights Hub, and thanks for tuning in.